Here's what just happened in the stock market that caught everyone off guard. On June 26th, the tech sector rallied hard. Investors poured money into technology stocks. But here's the twist. Two of the world's biggest AI companies, Nvidia and Alphabet, actually fell while the rest bounced. Nvidia built the chips every major AI model runs on. Alphabet owns Google. Together they are worth trillions. In a normal rally, they'd be the biggest winners, but they weren't. This signals investors are getting nervous about AI costs. The infrastructure is expensive. Nvidia and Google spend hundreds of millions quarterly just keeping AI running. When the market punishes them during a bullish day, it means investors don't think returns will justify the spending. That matters to you because it shapes which AI tools survive, which become cheaper, and whether this technology actually transforms the world or becomes an expensive experiment. The blind faith in unlimited AI growth is cracking. Investors are demanding real profits, not promises. The question now is whether companies can actually make money, and the market's starting to doubt it. This is where things get interesting. To understand why this market moment is unusual, you need context. For the past 2 years, AI has been the investment story. Every investor wanted exposure. Every company claimed an AI strategy. Nvidia became the most valuable company at one point. Valuations for AI companies hit ridiculous levels. Everyone assumed, if your business touches artificial intelligence, it will be hugely profitable. But here's the hidden reality. The costs are absolutely enormous. Building AI infrastructure requires specialized chips, massive data centers, tons of electricity, and armies of engineers. A single large language model company spends hundreds of millions of dollars per year just to keep the systems running. Google and Microsoft have locked themselves into multi-billion-dollar annual AI spending. They've bet everything that returns will eventually justify it. But in June 2026, investors are finally asking uncomfortable questions. What if it doesn't? What if you spend $5 billion on infrastructure and only make $2 billion in revenue? What if companies have built the world's most expensive money-losing machines? That anxiety is driving the market move. When chip stocks sink while the rest of tech rallies, it signals the blind faith is ending. Investors want proof that AI is profitable. Nobody's provided that yet. Here's what most coverage gets wrong about all this. Let's talk about why infrastructure costs actually matter this much. When companies build large language models, they first need to train them. Training models like GPT-4 costs hundreds of millions of dollars. You're renting thousands of specialized GPUs from data centers, running them continuously for months. That's just training. Then you have to serve the model. Every ChatGPT query costs electricity and hardware. Scale it to millions of concurrent users, and you're spending millions per day just answering questions. That's called inference, the cost of using a model after it's built. Now multiply that across every AI product a company makes. Google has Gemini, Microsoft has Copilot, Amazon has Q. They're all running these models 24/7. The electricity bills alone are enormous. Add data center maintenance, cooling systems, and the engineers managing it all. And you're looking at billions of dollars annually per company. Here's what investors are finally confronting. The money coming in from AI hasn't caught up with the spending going out. Companies spend $5 billion on infrastructure, but make only $2 billion in revenue. That gap is shrinking, but it still exists. And when investors see that gap, they panic. That's what the June 26th market move was really about, repricing the risk of AI infrastructure. And that changes everything about the industry's future. Let's put real numbers on the infrastructure spending happening right now. Microsoft alone is committing around $80 billion over 4 years specifically to AI data center build-out. That breaks down to roughly $20 billion per year. Google is spending at a similar scale. So is Amazon. Nvidia is scaling manufacturing. These aren't modest bets. These are fundamental reshapings of where capital flows in the entire tech industry. Here's where it becomes complicated. The payoff timeline is completely uncertain. A company can spend $20 billion this year on infrastructure, but it could take 5, 7, or 10 years to recoup that through subscriptions, IPI fees, and licensing. That capital gets locked in. That's risk. In 2024 and early 2025, investors didn't care about timelines. They believed AI would become instantly profitable. By June 2026, skepticism is growing. What if revenue never matches spending? What if getting profitable takes a decade? What if companies massively overbuild and waste capital? Those are legitimate questions, and they're driving the Nvidia and Alphabet sell-off. The market is starting to ask companies to justify their AI bets. And here's what's surprising, that pressure might actually be healthy for the industry. Understand this moment, compare it to previous tech crashes. In 2000, dot-com companies were valued on pure hope, no revenue needed, no path to profitability. The assumption was that building on the internet meant guaranteed riches. Then reality hit and the bubble burst. AI in 2024 and 2025 had similar energy. Companies were valued on the hope of having an AI strategy, regardless of actual revenue or profitability. What mattered was being in the game. But here's the difference. Real trillion-dollar companies like Nvidia, Google, and Microsoft are making the bets, not startups. These companies can't burn capital forever hoping for an exit. Eventually, they need to show profits. In June 2026, that eventually is arriving. The companies everyone thought would profit endlessly from AI are now being asked, when exactly do profits start? It turns out that's impossible to answer. When the market pressures trillion-dollar companies instead of startups, everything accelerates. The reckoning comes faster. That's what we are watching right now. And the fact that Nvidia and Google underperformed during a tech rally signals that investors are genuinely nervous about the answer. This moment is different from the dot-com bubble because the stakes are higher. These aren't failed startups losing venture capital. These are the world's biggest companies burning billions of shareholder dollars on infrastructure that might not generate expected returns. So what does this repricing mean for artificial intelligence's future? First, unlimited AI spending is ending. Companies will keep building AI, but far more carefully. Expect less experimentation with massive models and much more focus on efficiency, getting smarter results with less infrastructure. Second, AI pricing comes under pressure. When companies get nervous about profitability, they compete on price. That means cheaper API access for developers, potentially cheaper subscriptions for consumers. The entire economics change from build the biggest model possible to build the most efficient model possible. Third, smaller AI companies might actually gain advantage. Building a mega model requires billions in infrastructure spending. Building an efficient, smaller model costs far less. Right now, some of the fastest-growing AI companies focus purely on efficiency. When investors get skeptical about massive infrastructure spending, that advantage suddenly inverts. Fourth, AI is normalizing as an industry. It's shifting from magical technology that changes everything status to real business that needs to be profitable. That's actually healthy. It means the next phase of AI gets driven by practical applications and profits, not just by who can build the biggest thing. And here's what the headlines are missing about all this. Here's what actually matters if you're watching this space. First, ask companies about profitability timelines. When companies talk about massive AI spending, press them on when they actually make the money back. If they won't give you a timeline, that's a major red flag. Second, watch efficiency metrics obsessively. Companies that optimize for efficiency per dollar will outlast ones that just chase bigger models. Look at what models they deploy in production versus what they are researching in labs. If they are deploying smaller models, that's a signal they're getting smart about capital. Third, understand that AI investment isn't going to stop. It's shifting focus. The mindset is moving from build everything possible to build what's actually profitable. That's a huge difference. Companies get way more selective about which projects survive. Fourth, smaller AI players just became more interesting. Startups building efficient tools instead of trying to compete with open AI's scale are exactly the companies that could explode next. If you're investing in AI, efficiency is now the metric that matters most. Finally, watch Nvidia and Alphabet's next earnings reports carefully. Do they slow AI spending, raise prices to hit profitability faster? Their moves tell you exactly where the market's headed. Pay attention to that. Here's what this moment actually means for you and where to look next. The AI revolution isn't over, but its economics are shifting fundamentally. The era of burning billions of dollars without any profitability pressure is ending. What comes next is smarter, more efficient, more carefully allocated AI development. The winners in the next 5 years won't necessarily be the companies building the biggest models. They'll be the companies that figure out how to get results with less compute and less capital required. That changes which companies become industry leaders. It changes which AI tools survive and which ones disappear. For you as an AI user, this is actually good news. More efficient AI usually means cheaper AI, better integration into the tools you already use daily. AI that actually becomes practical instead of staying trapped in research phase. For you as an investor or potential builder, this signals exactly where money flows next. The billion-dollar AI companies won't come from massive training runs. They'll come from making current models work profitably in the real world. Watch Nvidia and Alphabet's next earnings calls. Their response tells you where the industry is actually heading, not the hype, the reality. The real AI revolution isn't about scale or sophistication. It's about models that actually make money. And that change is happening right now.